We've seen in an earlier session that the two biggest segments of the long-term financial markets, or capital markets as they're called in some countries, are the bond market and the equity stock market. Investments in the bonds issued by a firm represent a share in the borrowings of that firm. On the other hand, investments in the equity stocks or equity shares or common stock, as it is referred to in some countries, represent an ownership claim in that firm. We've already looked at the bond markets in great detail in earlier sessions. In this session, we will focus on the equity stock market, the underlying theories governing the pricing of equity stocks, the market infrastructure and mechanisms that enable trading in the equity stock market, the regulatory framework within which equity markets operate. To begin with, let's quickly look at the structural differences between the bond market and the equity market. Firms requiring long-term capital will need to source debt or equity or both. Debt is raised, as we have already seen, by issuing bonds or by taking a loan from a bank. Equity capital, on the other hand, is raised by issuing equity stocks of the firm. Debt capital assures the investors a contracted return in the form of either coupon payment on the bond or interest payments on the loan. On the other hand, returns on equity are residual, that is, dependent entirely on the profit after tax generated by the firm. In a year of low or no profits, the return to the holders of the equity stocks will be low or negative, and in a year of high profits, the returns could be really high. In view of the above structural differences between bonds and equities, the return to equity shareholders are significantly more volatile than the returns from investments in bonds, and hence investments in equity stock is considered to be significantly more risky than investments in bonds. Do recall from early finance lessons that return in the case of equity stocks measured between any two successive periods will be computed as the change in the stock price during that period, which is treated as the capital gains, plus the dividend paid during that period. Expressed mathematically, the return on the equity shares at any point t is Pt minus Pt minus 1 divided by Pt minus 1 plus dt divided by Pt minus 1. Now let's understand each of these phrases. RT is the return on the investment between time t minus 1 and t. Pt is the stock price at time t. Pt minus 1 is the stock price at time t minus 1. And dt is the dividend paid during the period t minus 1 to t. In the course of the discussion board, we will work through some problems to better understand this concept. Apart from the volatility in the returns discussed earlier, equity stocks also have a few other unique characteristics. Let's look at those in some detail. Equity stocks issued by a company is perpetual. In other words, they have no maturity date and are valid as long as the firm that has issued the stock is alive and operational. 2. In the event a firm is declared insolvent or shuts its operations for any reason, equity stockholders have the lowest priority claim on the assets of that firm, only after other claimants including employees, government, debt holders, etc. And all of them should be paid off. Only the residue value goes to the equity shareholders. Next, liability of the equity shareholders and consequently their potential maximum loss is limited to the extent of their investments in the equity stocks of that firm. While the equity stockholders have no interest or control over the day-to-day management of the firm, they do have cash flow rights manifested as dividends proportional to their stock holding in the firm, and more importantly, control rights manifested as their right to elect the board of directors of the company, their ability sometimes to veto the choice of the CEO of the company, and issuing of additional equity stocks, and so on and so forth. Now let's look at the difference between equity stocks and preference stocks. Unlike equity stocks that carry a dividend that is not contracted and whose market price varies on a continuous basis, preferred stock attract a fixed dividend and prices do not vary. Preference stockholders have claim on the assets of the firm that is higher than that of the equity stockholders but lower than the bondholders, lenders, and the other creditors in the firm. In most countries, not surprisingly, preference stocks as a percentage of equity stock issued is very low because this could adversely affect returns to the stockholders. This is because interest payments on bonds or interest payment on loans result in a tax shield and hence impact profit after tax favorably, whereas dividend on preference stocks is paid out of the profit after tax, that is, after tax have been deducted. Let's look at an example to understand this better. Say a company has earnings before interest and tax of 200 million currency units, corporate tax rate of 30%, and total long-term capital of a billion or 1,000 million currency units, comprising 500 million of equity capital and 500 million of debt at an interest rate of 10% per annum. The profit after tax of the company with that capital structure will be computed as follows. Let us say earnings before interest and tax for this company is 200 million, less interest at 10%, which works out to 50 million, will go to the debt holders. So the profit before tax is 150, less tax at 30%, which would take away another 50, which will have to be paid to the government, and the profit after tax will be 100 million, all of which would go to the equity shareholders. If 60% of the debt is replaced by preference shares on which dividend is payable at 10%, the capital structure of the company after 60% of the debt is replaced by preference shares will be equity capital of 500, preference shares of 300, debt capital of 200, adding up to 1,000 million or 1 billion currency units. Remember, the preference shares will get a dividend of 10% per annum, and the debt capital, the company will have to pay interest at 10% per annum. If we recompute the profit after tax of the company after the change in the capital structure, we start with the same EBIT of 200 which we saw earlier, less interest at 10%. Remember, now the debt is 200 million, so you have to pay 20 million as interest to the debt holders. So the profit before tax is 180, less tax at 30% of 180, which is 60, which gives an effective profit after tax of 120. Because we have issued 300 million of preference shares, we will first have to pay dividends at 10% on the 300 million, which works out to 30 million, and all of that would go to the preference shareholders, which leaves a balance of 90 million, which will go to the equity shareholders. Remember, when the capital structure did not have preference shares, the profit which was assignable to the equity shareholders was 100. Now the profit that is assignable to the shareholders has come down to 90. The reduction of 10 million in the profit after tax is a result of the reduced tax shield because 300 million of debt has been converted to preference shares.